G'day! Today we're talking about trading statements. Now when we talk about trading statements, people say, oh, what's that? A trading statement is a summary of what you've earned and what it's cost you to earn those when you've got a trading business. Now that can be a retailer, it can be a restaurant, it can be pretty much any sort of business that buys something or manufactures something and on-sells it. So I'll give you a quick example. Which will help explain what we're on about. When we talk about a trading statement, and I apologise for the writing, when we talk about trading statement, we'll generally have a thing called sales. Let's say we've got sales of $100. And then we'll have what's called our COGS account, which equates to cost of goods sold. Okay, now in this example I'll assume that we've got stock. Okay, we buy stock or manufacture stock, but we've got a thing called opening stock, or people can call it stock on hand. So we'll have opening stock. Let's say we've got $50 worth of stock on hand. Then we'll have purchases. Let's just assume we're a retailer. So we've bought some stock during the year that we've then sold. So let's say we've bought $80 worth of stock. So that gives us $130 there. Now from that we then go less closing stock, because that's still on hand. We haven't sold that, so the closing stock isn't included in these sales. So the closing stock figure, let's say we've got $60 worth of closing stock at the end of the year. That means that our total cost of goods sold here is $70. Okay? Actually, I'll do it like accountants should do it. We'll shift that over to there and say, right, we've got $70 worth of cost of goods sold. That then means our trading profit here, or what I generally prefer to call it, is gross profit. Your gross profit is $30. So we've started off with $50, we've bought another $80 worth of stock, we've still got $60 worth of stock on hand, which means that our cost of goods sold is then $70, which means that our gross profit is $30. So with the example that we've used, where we've got $100 worth of sales, $70 worth of cost of those sales, leaving us with a gross profit of $30, I want to help you understand what the issue is when we talk about stock or inventory and the levels of inventory that you hold. We'll use this same example, but I'm going to change one figure. So what we do is, instead of having $60 worth of closing stock, we've got $80 worth of closing stock, which means that our cost of sales is now $50, which means that our gross profit there is $50. So because our closing stock figure has gone up by $20, our gross profit figure has gone up by $20. Now this is a really important thing that people don't realise, because they think, I need more stock, I need more stock, I need more stock. It will actually make you more profitable, but you're tying a whole heap more money up in your stock. So you need to be very, very careful of that. One thing too we look at, and I'll talk about this when we talk about KRIs, KPIs, KRAs, those sort of things in a later episode. But one of the things that we look at here in this example, we've got $100 worth of sales for the year, and we've got $80 worth of stock on hand at the end of the year. Now that is nearly a whole year's worth of stock, based on our margins and all that. We'll talk about that in more detail. But you've got to actually try and keep your stock levels, your closing stock levels, as low as possible. So let's see the impact when we change that closing stock figure to a lower number. So we've still got everything right to there, the $130 worth of $50 worth of opening stock, $80 worth of purchases, giving us $130. Now we change this figure to $40 from the $100. So we've got $130 from over here. That then gives us a cost of goods sold of 130 less 40, $90. And that then means that our gross profit is $10. Now, which business would you rather have? So you really need to be careful when you're looking at trading statements to be aware of the impact of particularly the difference in the closing and opening stock figures. So here we've got marked differences which all, even though the business has got the same level of sales, the stock levels at the end of the year have a profound difference, have a profound effect on the profit, the gross profit of the company. So you need to be very, very aware of the power of stock and how it impacts both your opening stock and your closing stock. And this closing stock from this year will then be your opening stock next year. So you need to be very, very aware of the impact of varying stock levels across your business. Cheers.